Welcome everyone, welcome to the Fibonacci retracement training series. In this series and training, we'll be going over in detail how to use the Fibonacci retracement tool in Forex in order to take very high probability trades in the trend. What we'll learn by the end of the series is how to use Fibonacci retracement tool as a confluence tool in order to find higher probability trades. You will also learn a powerful trading method which I refer to as the Fib 5618 trade. The series will also combine the knowledge of what you have learned so far in the Engulfing Trader series and in the 5-day trend trading series. And with that understanding of structure and trends and major structure, you will see how using the Fibonacci retracement tool as well can help create an even higher probability trade. First of all, what is Fibonacci in trading? What is Fibonacci in Forex? Fibonacci is a number variable that can help predict psychological trading zones on the Forex chart in trending market conditions. So this is a trending tool overall. Not only that, Fibonacci variables is also used in many forms of advanced mathematics. Plus, Fibonacci is also used by banks, institutions, and big traders for making decisions. Now, this is one of the really key important factors of why we need to pay attention and why it's important to pay attention to this tool in our trading, especially when we're trading the trend, which is a key factor to keep us more profitable in the Forex market. Because of all these reasons, the Fibonacci tool is very valuable to a trader and can provide an edge in trading if used alongside other confluences. Now, I'll get into that in a moment, but I'll give you a quick summary. Another confluence is just another reason to take a trade, because we are all sort of price detectives when we open a position. We're looking for reasons to take the trade, the reasons that this trade would work in our favor. As we all know, not all trades are going to work out, but we're looking at ways to make it so we can improve our edge in order for the majority of our trades to work out in our favor. Okay, now this is an important tip first, which we will also see on the charts as well. Firstly, Fibonacci is used in trending markets and should only ever be used when it aligns with other confluences such as structure and price action. And what I'm referring to with price action at the end here is candlestick price action. In other words, Fibonacci should not be used as the only reason to enter a trade. However, if combined with other reasons, provides an extremely high probability trade. And that's what we'll be focusing on in this series. Now, certain variables of Fibonacci in Forex are more high probability in Forex than others. And in this series, we'll focus on only the highest variable of retracement, only the highest probability variable to give us a high probability trade. The highest probability retracement variable with Fibonacci is being the 50 to 61.8 retrace zone in a trend, right? Here are some examples of it in an uptrend. Right? So as you can see, we look here, we had a previous high just here. Price went lower as the market was heading down, and then price broke above that high, pulled back into the zone, and pulled back to exactly around the 50 to 61.8 pullback zone, and then the price goes higher. And this is not just a one-time thing. As the market kept pulling up higher, it would pull back to this zone very commonly. So that's what we're really focusing on, is common pullbacks in the market and aligning with other confluences, which we'll go over a bit later, right? Here are some examples of it in an uptrend again. Same pair, just a little bit higher, and as you can see, price moved along further. We were looking at this one before, and the price moved along and then pulled back again to around the 50 to 61.8. Same pair again, a little higher again, showing a new higher high, then pull back, and as you can see, it pulled back again to around the 50 to 61.8. Okay? And here's another new higher high and a pullback to, yep, you guessed it, another example of the 50 to 61.8 retrace. So now you're getting the point that in trending market conditions, this is commonly a very good pullback zone. But like I said, we need to combine it with other confluences, which is what we'll go over in the series as well. But you're getting my point here. Around the 50 to 61.8 retrace zone is a high probability zone. Now also, when we go onto the charts, we'll also go over how to draw this as well. So don't worry if you're sitting here thinking, how do I draw this? How do I draw this retrace zone? We're going to go over that in detail when we go onto the charts. I'm going to give many examples. I'll be giving examples on the 1 hour time frame, on the 4 hour time frame, and even the daily time frame. Right? However, this can be used on multiple time frames, but these are the time frames which I prefer and I think are the best time frames for using Fibonacci overall. Okay, and best time frames for using trend. Now, of course, it can be used on the weekly as well. You can just adopt that knowledge to even higher time frames if you so wish. Okay, so now let's go over some examples of it in a downtrend. Well, I showed you in an uptrend. Let me just show you some examples in a downtrend. Okay, so here's the same pair. As you can see, we just broke, created a new lower low. This was the previous low just here. And price moved lower and then pulled back to where? The 50 to 61.8. Then price broke lower again, lower than that previous low, and then where'd the price pull back to? The 50 to 61.8. Okay? And then once again, price broke lower again, forming a new lower low again, and then it pulled back to where? The 50 to 61.8. And the market keeps doing this until it creates a new higher high from a downtrend, or until it creates a new lower low from an uptrend. Basic formations of the market, and we'll also go over some examples of this on the charts. What sort of markets you want to be looking for in a moment. What sort of markets you want to focus on for trading the Fibonacci. Right? We want to look at trending markets, and I'll show you some examples of that in a moment. So overall, there are a number of factors to look at when and before using the Fibonacci retracement tool, which I call the TSCF. TSCF stands for Trend, Structure, Candlesticks, and Fibonacci. So it's a little bit of a process we go through when we're taking a TSCF trade, right? And you could also call the trade itself the Fib 5618. What this means is we want to see a trending market structure, candlestick price action, the aligning of the 50 to 61.8 Fibonacci retracement tool as well. Note, of course, the structure could be a midway trend structure, such as what we go over in the 5-day trend trading series, or major structures, such as what we go over in the engulfing trader series. Now let's jump over the charts to see what sort of trending markets are best for using the Fibonacci retracement tool. Well, welcome back, everyone. In this section of the series, we'll be going over how to identify the right market. What sort of markets are good for Fibonacci? So let's look at two examples. Let's look at two examples, one from the downtrend perspective and one from the uptrend perspective. First one being the downtrend. Now, first of all, it doesn't matter what sort of time frame you're referring to here. Okay, it could be the 1 hour, it could be the 4 hour, it could be the daily, or it could even be the weekly. Right? It could even be lower than the 1 hour time frame. The important factor is that the market looks like this, that it's continually, if it's a downtrend, producing lower lows or lower highs, or if that it's an uptrend, it's continually producing high lows and higher highs. So let's get into it. Let's do some quick analysis of this type of market and how we can see it as a good market in order to trade the Fibonacci retracement tool. Okay, so let's begin. Well, first of all, let's look at this first extension leg when the market was going lower. Now, this market as a good example, because this market has been in a downtrend for quite a while. And it's always really good to identify the trending markets in order to trade these type of tools. Right? Because these are the sort of markets that we only want to trade the Fibonacci retracement tools, as I mentioned in the previous aspect of this video. Right? Okay, so first of all, we got a new lower low. Lower than this low, lower than this low, and lower than this low, right? Then we got a new lower high. Then we got a new lower low. Then we got a new lower high. Then we had new lower low, got a new lower high. Then we had another new lower low and another new lower high. Great sequencing, right? And this is the sort of market that is the best for trading Fibonacci retracement tool for a downtrend. Okay, so let's jump over and actually look at an uptrend example. Okay, so this is a great example of an uptrend. Now, how do I know this is an uptrend? Well, let's have a look. Just previously in the past, you can see that the market came down to this zone. We started producing a bit of a higher high than the previous lows. Price pulled back in those lows, producing a higher low, and then price pushed higher, producing a higher high. And so we got these sequences of started forming higher highs and higher lows, higher highs and higher lows, high highs, high lows, high high, and high low. Another high high, high low, and then eventually getting more higher highs and higher lows. And so this is a perfect example of an uptrend, right? And this is the sort of perfect market to be trading the Fibonacci retracement tool, right? Which we'll go over further in this series in future video parts, right? And this is the sort of market you only want to be trading for an uptrend with this tool as well. It's important that when you use the Fibonacci retracement tool that the market is trending. So now I've just given another great example, this example being in an uptrend. Now, like I said, it doesn't matter what market it is, that's not important. The important factor is the market trending? Is it looking like this? Is it producing higher highs? Is it producing higher lows? And if those conditions are met and those evidences are met, then you can start using the Fibonacci retracement tool. And like I said, in future video parts, we'll be going over some demonstrations of using this tool, right? Where to place stops, right? Where to enter, where to use extra confluences, right? Such as structure and price action. And so you'll get a bit of an edge. You'll get an understanding of how to use this tool in your trading in order to create a high probability trade. So let's just have a look at this again. Higher highs, higher lows, higher highs, higher lows, higher low, higher high, higher low, higher low, higher low, and this gives you a nice upward trend sort of perspective for using the Fibonacci. Let's go back to the downtrend again, and I'll just quickly recap. The downtrend producing lower highs, lower lows, lower lows, lower highs, lower lows, lower highs, lower highs, and lower highs. And like I said before, that you could be using this on any time frame. The important factor is that the market looks like this. Right? So now you know what to look for a downtrend, or what to look for whether the market's in an uptrend. And they're the sort of markets that you want to be trading this tool in only. Well, thanks for watching this video part. See you in the next video part, and I'll show you exactly how this works on the live charts. Okay, thanks for watching, and I'll see you in the next video.